It's another great time we meet for a bit of our discussions, which we do through the online platforms. That is a CPA YouTube channel. So this is the relevant home of accounting. So subscribe to the channel, share so that we can be able to achieve the relevant targets. Going to the topic of today, I would like to do a financial reporting and analysis. That is a question of consolidation, May 2021, whereby we have to prepare the consolidated statement of financial position. So the May 2021 question, that is question 5, May 2021 question 5. So the question reads that on 1st April, so I've said that it's May 2021 question 5. May 2021 question 5. So the question reads, so on 1st April 2018, Ambassa Limited acquired the following inventories: 1,000, that is under 320. So I'm talking about in thousands, so it was in millions anyway. They were saying that 1 million, he acquired 1,320,000 equity shares in Rhodesia Limited at the cost of shillings 27,300,000, when the retained earnings of Rhodesia Limited were shillings 12,500,000. 50, he acquired again 50% of Rhodesia's Limited, 12%, debentures at par. We are required to do the statement of financial position, the consolidated one. So checking on the statement given, we are given a statement of financial position for the two entities, that is Ambassa and Rhodesia. Additional information, we are told that the fair value of Rhodesia Limited's assets as at the date of acquisition was equal to their carrying value, except an item of a plant which had a fair value of 1,600,000 in excess of its carrying value. The plant had a remaining useful life of 4 years. So this is all about revaluation. Remember that the revaluation gain is the difference between the fair value of an asset and its carrying amount, of which the fair value is always in excess of the fair value is in excess of the carrying amount, whereby the carrying amount is below the fair value. So here they said that there was 1.6 which was in excess of the carrying value. So the fair value, there was a fair value of 1.6 in excess of the carrying value. So that is a revaluation gain. Number 2, on 15 March 2020, Rhodesia Limited sold goods to Ambassa Limited for 700,000, or on credit terms. The goods had not been received by the company as at 31st March 2020. So we need to record them because they have not been received and they were on credit. And they were not included in closing inventory. So no entry had been made in the books of Ambassa Limited. In respect of this transaction, so Rhodesia Limited sells goods to all customers at a standard markup of 16 2/3. So we need to check UPS on those goods which were unsold by the other entity by the end of the year. So remember that when one entity sells goods to the other entity at a profit, that is, for example, here now the parent was selling maybe to its investee company goods at a profit. So, but the investee company never resold all of those goods. What are we supposed to do on this scenario? So if the investee company never resold all of the goods, we need to check the unrealized profit on those goods so that we adjust. That unrealized profit in the books of the parent. The aspect of UPS, I think you know it. You have been interacting with more of my videos, and if it's the first time you are coming to this channel, there's more videos which can assist you in addition to this one. Number 3, as at 31st March 2020, the accounts payables of Ambassa included 750,000 due to Rhodesia before taking into account the above transaction. So this was just an intergroup owings, the outstanding balances, which we need to eliminate because now they are not supposed to owe each other in the next financial year. Because at the end of the year, the parent will consolidate those investee companies. The ambassador had not accounted for dividends receivable from Rudisha. We will account for that, whereby the parent will take his share and the minority shareholders will take their share. Goodwill arising on acquisition of Rudisha was considered impaired by 20% as at 31st March 2020. We will impair our goodwill. The fair value attributable to non-controlling interest amounted to 6.8 million. So when you are provided with the fair value of the non-controlling interest, it means that when I will be doing the goodwill of the investee company, when the parent will be doing the goodwill of the investee company, when ambassador will be doing the goodwill of Rudisha, you will either use, for this scenario you will use full method, because already you have been provided with the fair value of the non-controlling interest. So, student, this question was having 20 marks. A very easy question which can make you pass in an exam. Very easy question. 20 marks, once you score that, you need around the other questions you score 10. And that's all. You will make it. So it's very easy to pass. In your exam next week, I wish you all the best. And obviously apply the easier ways of finishing a question within the shortest time possible. Because a question needs only around 40 minutes. So here, the first thing we could have determined is what about the percentage ambassador had acquired Rudisha up to. Because you were never provided, you were given the number of shares. So you know that the ambassador had acquired Rudisha. So you are told that he acquired just shares. That is the thing you were told at the start of that question. He acquired 1320. So my question would be in terms of thousands. So this one was in millions, 1.3 million. But now I'm reducing it to thousands. So using these shares which were acquired, I can be able to determine the percentage. So I will go to my statement of financial position. Under Rudisha, I check the ordinary share capital, which is there. So for them to raise a capital which is given there of 16,500, it means that they issued how many shares to raise this money. So per share, for them to raise a capital of 16,500, remember that per share was shillings 10. So meaning that the number of shares they issued is 1650. So to get the percentage which Rudisha acquired, which Rudisha was acquired, because ambassador is the one which acquired Rudisha, we take 1320, we divide 1650, then we multiply with 100%. We multiply with 100%. So let's pick our calculator and get that percentage. So 1320 divided by 1650 times, so times 100, that is 80%. That is 80%. So which means that Rudisha is a subsidiary. So the next thing to check is all about the timing when Rudisha was acquired. Remember that our financial year ends on 31st March 2020. It starts on 1st April 2019, and this is the time when Rudisha was acquired by Ampasa. That is at the start of the question. Was it acquired in 2019 or 2018? It was acquired in 2018, not 2019. So 1st April 2018. 1 year back. 1 year back. So meaning that in the previous year, they had already prepared their books. What will be required is just to prepare the books for the current year, 2019-2020, 2019-2020. So once we have our percentage, and we know that Rudisha is now a subsidiary, I can be able to do what is required. So the examiner was in need of a consolidated statement of financial position. So we just write the heading. I say Ambasa. I will just say Ambasa. Consolidated statement of financial position. Statement of financial position as at 31st March 2020 as on 31st March 2020. So we start from the aspect of non-current assets. We talk about non-current assets. So for the non-current assets, we have PPE, property, plant and equipment. So for the property, plant and equipment, we talk of the parent plus subsidiaries. So parent plus this subsidiary. Under PPE, property, plant and equipment, you are supposed to add revaluation. Revaluation was provided in additional information number 1, whereby you were told that a plant had a fair value of 1,600,000 in excess of the carrying value. So that is revaluation 1.6. So that is what you add. So there's that revaluation you are supposed to add there. So after adding revaluation leads to depreciation under charge. Revaluation leads to depreciation under charge. So you were given in that same additional information number 1 the remaining useful life of 4 years. So 16 divided by 4. So 1600 divided by 4. 16 divided by 4. That is 400. That is 400. That is 400. So that is what we are told. That is 400. Because we were given the remaining useful life of how many years? 4 years. We were given the remaining useful life of 4 years. So that is what you need to know, that after you have a revaluation gain, remember that revaluation gain, the figure of revaluation gain, this figure of a revaluation gain has not been subjected to what? To depreciation. Has not been subjected to depreciation. So this is the revaluation gain. This is the revaluation gain. So now to get the depreciation under charge, you will either be told that the percentage you are supposed to depreciate with that value is this one, or you are given the remaining useful life. You will be given the remaining useful life. But remember now, this one was based on the assets. This one, the 400. After taking 1600 divided by 4, we have the depreciation under charge for 1 year. But remember now, this one, it must be cumulative. This one must be cumulative. Because the B, that is not B, but Rhodesia was acquired 2 years back. So this is just for 1 year. So we have to do what? We have to multiply by 2 in order to get 800, because the relevant asset has been depreciated for the 2 years from the time of acquisition. That is from the time Rhodesia was acquired. So which means that we need to minus what? The 800. Because this asset, the asset has not been subjected to depreciation. So we deduct. Then after that, if there was something we call UPFA, I could have deducted. Then I add depreciation over charge. Where does UPFA arise from, and how do we determine it? Let's say today, parent Ambassa sold a fixed asset to the subsidiary. Remember that when the parent sells a fixed asset to the subsidiary will never resell that fixed asset. So meaning that the profit which the parent realized will never be realized by the subsidiary. So that is what we determine. That profit which was never realized by the subsidiary, but it was realized by who? The parent. So that we adjust in the books of the parent, because the profit of the parent is overstated by what the subsidiary never realized, because he never resold that fixed asset. So that we adjust our asset account and the retained earnings, because if there is unrealized profit by one entity, but it's realized by the other, so the accounts of the other entity, the profit is overstated. We need to eliminate that profit overstatement. And at the same time, it affects the asset account. So how do you determine this? It's all about transfer value. The value at which the asset was transferred times profit margin. Then after this, you determine depreciation overcharge. Because that asset which was sold from one entity to the other, you will be told that both entities subjected this asset to depreciation. Both of them, they subjected the asset to depreciation. So if they subjected the asset to depreciation, both parent and subsidiary, they did an overcharge, meaning that they understated the value of the asset. We need to adjust that in our books. So how do you determine this? You get UPFA times depreciation rate. Or if you will be given the useful life, you take the UPFA, you divide the remaining useful life. Remaining useful life. So that information was not there. So that is how you were supposed to consolidate the property, plant and equipment. So the next one, under investments, remember that investment in subsidiaries replaced by goodwill. But there's something I need to confirm here, because checking in my non-current assets, the investment with the parent made, in the investee company is all about 52,600. But checking the amount which he paid, because according to the question, at the start of the question, it's all about 27,300. So these amounts are not the same, and they are supposed to tally, because this is the amount you were told Ambassa paid at the start of the question when he acquired Rhodesia. So there's a difference of 52,800 minus 27,300. So this is 52,600 minus. So this is 25,300. So other than 27,300, which he paid, remember the other investments were on the debentures which he acquired, the 50% debenture. He also acquired the 50%. He also acquired the 50% debentures. The 50% debentures. The 50% of the 12% debentures in Rhodesia. And the 12% debentures in Rhodesia, if you check under non-current liabilities, is 2,800. So this one is giving me 14. So if I minus 14 here, because this one was part of the investment, still it's not coming the same as this. We cannot get 27,300 because this and this are supposed to be the same. So this was the investment, but we are told when Ambassa was acquiring Rhodesia, he paid this, and also he acquired 50% of the 12% debenture, which is 14. So which is part of the investment. So 25,300 minus 1,400. So this is 23,900. So that balance, where would I record it? The 23,900. So that is what we call other investments. Other investments. So I will take 23,900 plus the one in the subsidiary. So in the subsidiary we have 4,800. We have 4,800. So it needs some working. So this one needs some working to check the goodwill of Rhodesia. For the Ambassa to compute the goodwill of Rhodesia, we have to do the working. So the next thing I will consolidate here is all about inventories. So for inventories, I will talk about parent plus subsidiaries. So 6350 plus 5,200. So I will minus the UPS and realized profit on stock, UPS, on the goods which were sold. So on the goods which were sold is all about note 2. Rhodesia sold goods to Ambassa for 700. So when Rhodesia was selling these goods to Ambassa for 700 on a credit basis, the goods had not been received by the company. We will record them because they have said they were not included in closing inventory. So I will record by adding under inventory. So then no entry had been made in the books of Ampasa. In respect of this transaction, Rudisha sells goods to customers at the standard markup of 16 2/3. So remember that when Rudisha was selling these goods, this is the markup included in those goods. So if we put this one to be a proper fraction, it will be 50/3, that is percent. So 50/3 is like a 50/3/100. So I change this one by saying 50/3 times the reciprocal. That is a 1/100. So it will be 50/300. So this is this one. So this is 1/6. So this is markup. Changing to margin, you add the numerator to the denominator. So this one will be 1/7. Unsold goods, it was just the entire value, because these goods had not even been received by the other entity. So we multiply. So UPS is all about unsold goods. Unsold goods times margin. Times margin. Remember, margin is 1/7. So this one will be 100. So that is what I minus here. Then I add those goods because they had not been recorded. Then receivables. So for the receivables, we talk about for the 360 plus 1950. There was some intergroup owings which you forgo by deducting here the 750, and also it will be deducted under the payables. Remember that if there is outstanding balances between the parent and subsidiaries and it has not been settled by the end of the year, they are not supposed to owe each other in the next financial year, because the parent will consolidate the subsidiary by the end of the year. So any intergroup owings by the end of the current year under consideration, it's cancelled out. It's supposed to be cancelled out. So, and that is what we have done. Then, and that is the receivables. Then for the bank, we have 1390 plus 0. 1390 plus 0. So the 1390 plus 0. So if there was cash in transit, remember we are supposed to add here cash in transit. Because now if one entity paid the other entity and the amount was on transit, remember that by the time it will be received, they have not recorded, because it's all about after the few days after the end of the financial year. So we record the cash in transit by adding here and deducting here. Then these goods which were sold and were never received by the other entity, remember that they were on credit basis. So I had to add here, that is 700, and at the same time we minus under the receivables. So we recorded them, the goods which were sold. Then, I think up to that point we are done with assets. So we get total assets. We get the total assets there. Which are the other items to record? The equities. Remember that the equities are the easiest items you can record. You can consolidate. Because right now, ordinary share capital, you record parent only. Share premium, you go with the parent figure only. The only part which require working is all about the retained earnings and checking the capital of the minority shareholders. So we talk about equity and liabilities. So the equity and liabilities. So for the equity and liabilities, we have ordinary share capital. Ordinary share capital. So for the ordinary share capital, parent. So the parent figure is all about 43. It's all about 43,000. For retained earnings, I will do working. For retained earnings, we have to do working. Then I will introduce here non-controlling interest to check. Non-controlling interest. So this is working and this is working. So I'm doing the non-controlling interest to check their capital. To check the capital of the minority shareholders. I will do that to check the capital of the minority shareholders. And that is okay. So the next thing to check is all about how we are supposed to consolidate liabilities. So starting from non-current liabilities. Starting from non-current liabilities. So for the non-current liabilities, we talk about 12% debentures. So 12% debentures. So 12% debentures, that is 82. 100 plus 28. Then we minus 50% of 28 because this one was part of investment. That is what they said at the start of the question. The parent again acquired 50% of this. It was part of the investment with the parent made. So it's not a liability. That is what I'm deducting from that point there. Then deferred tax. So for the deferred tax, we talk about 3,900 plus 1,200. Then current liabilities. For the current liabilities. So for the current liabilities, we talk about payables. Payables. 5710 plus 1760. So I said for us to forgo an owings, we always credit receivables and debit payables. So debiting payables, we need to minus here. So for us to forgo an outstanding balance, which has not been paid by the end of the year. That is an amount which has not been paid by the end of the year, which has not been settled by the end of the year. The 750. According to note 3. As at 31st March 2020, the accounts payable of Ambassa included 750 due to Rhodesia before taking in account the above transaction. That was outstanding and it has not been settled. Settled. So after the payables, we have recorded that. We record the other items. In a direct manner. Like now, taxation is just direct. We just add. So taxation, we have 53, 30 plus what? 53, 30 plus 24, 10. Then dividends. So there's something here now. They said about dividends. So dividends, they said in note 4 that Ambassa had not accounted for dividends receivable from Rhodesia. So we'll account for that. So which they will affect NCI and retained earnings. So on this scenario, I will talk about 13. But now to record the one for the subsidiary, I have to consider 20%. I have to consider 20% of 1,200. Then 80% will be added to the retained earnings. 80% will be added to the retained earnings. So that one is giving me 15. So that one I'm getting 15 what? 1540. Then for the others which are remaining, we have a bank overdraft. So bank overdraft, that is just 0 plus 1950. So you get 1950. So first, if you can be able to do this way, you have a lot of marks. So let us first get these figures. Let us first get these figures of ours. 37,300 plus 24,060 minus 1,600 plus 800. So these are about plus 1,600 minus 800. So this is 62,160. So for the other investments, 23,900 plus 4,800. So this one is 28,700. So this one needs a working. Goodwill. Then inventories, that is 63,50 plus 5,200 minus 100 plus 700. This is 12,150. Then 43,60 plus 1950 minus 750 minus 700. This is 48,60. This is 13,90. So this one needs a working. That one needs a working. So that our 12% debenture, that is 8,200 plus 2,800 minus 1,400. So this is 2,200. 3,900 plus 1,200. This is 5,100. 5,710 plus 1,760 minus 750. 6,720. So 5330 plus 2410. So this is 7740. So if you do this way, I was saying that even if you do this way, you have a lot of marks, because in a FAR they mark, like now this one, they were in need of 20. They can decide to give you 1 mark for every entry. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So far you have 12 out of 20. So there are some workings here anyway you can do, which are direct, like goodwill, like NCI, interest. Anyway, we have only 3 workings, so I can be able to do them. So these 3. So let us do them. So let us do the workings. So let me talk about goodwill. So remember, the goodwill is all about purchase consideration minus share of net assets acquired. Share of net assets acquired. So here we are using full method because the parent will be doing the goodwill of Rhodesia as acquisition date, of which as at that acquisition date you have been given what? The fair value of NCI. So if you are provided with the fair value of the NCI as acquisition date, the parent will compute this goodwill using the full method, of which the goodwill would be attributable to parent and NCI. So purchase consideration being, you were told at the start of the equation they paid 27,300. So fair value of NCI was given in note 6, being 6.8, 6,800. You raise share of net assets acquired. Share of net assets. So share of net assets, the first one being ordinary share capital. So here I would say 80% and the 20% of the equity components of the subsidiary, that is Rhodesia. You have 16,500. The next equity component was about retained earnings. And the retained earnings you use must be as at acquisition date. That is the one which is provided as at 1st April 2018. So you say 80%, 20% times. So you were told at the start of the question, the retained earnings of Rhodesia was 12,500. Then the next thing I have to record here is what about the revaluation reserve. Again, the revaluation reserve must be as acquisition date, and that one was well catered to 1, being 1.6, the fair value of Rhodesia Limited assets as at the date of acquisition. So it was 1.6. So there was no another equity components other than the 3. So we can use our calculator now to get these figures. So 80% of 16,500. So this is 13,200. 20% of the same. So 20% would be 3,300. So 80% of 12,500. So this is all about 10,000. So meaning that this is 2,500. Then 80% of 1,600. That is 1,280. And the 20% is 320. That is 320. So what do we do? We can subtract. So 27,300 minus 13,200 minus 10,000 minus 1,280. So this is 2820. And the other one, 6,800. 6,800 minus 3,300 minus 2,500 minus 320. So this is 680. So this is goodwill. So if you add the two, total goodwill would be so 2820 plus 680. That is 3,500. Was it subjected to impairment? You were told in additional information number 5, goodwill arising on acquisition of Rhodesia was considered impaired by 20% as of 31st March 2020. So impairment is 20%. 20% of the 35. So 20% of the answer. So this is 700. So 3,500 minus answer. So you get 28. So 28 is what you record here. 28 is what you record as goodwill. So my next working is all about concerning the retained earnings and non-controlling interest. The retained earnings and non-controlling interest. You can see it's very simple. These things are very simple. So you just relax in your exam when doing these computations. You just relax and do them. So never be in a tense mode. So once you relax, even your mind will be able to remember what you have been studying. Once you relax, even your mind will be able to remember what you have been watching in this platform. Apply them. You can't fail if you apply what I've been doing here. So for the retained earnings, let me start from NCI. And this one is another one you can be able to do. Very easy. You start with net assets on the credit side. So we have the ordinary share capital. We were having retained earnings. We were having the revaluation reserve. Remember that NCI is the percentage unacquired in Rhodesia, the 20%. So I would have to apply 20%. I would have to apply 20%. So the way they are from the question. So from the question we have 16,500, the ordinary share capital. We have 8190, and the revaluation was 1600. So this one I have picked them from the statement of financial position. Then for the revaluation reserve, it's under additional information number 1. Then the next thing we come here and record is all about the goodwill of the NCI if we use the full method. We have just determined some few minutes ago it was 680, the goodwill of the NCI. Then if there was depreciation overchange, we record here. So it's all about net assets. It's all about net assets, goodwill of the NCI, and the depreciation overcharge. So here we have depreciation undercharge. On the other side it's overcharge, including UPS. If we have an upstream sale and impairment. So remember that the sale was upstream and our UPS was 100. Remember we computed that. Depreciation under change, it's variable because there was a revaluation. So we got 800. We did our working on that. Then impairment was 700. We have done it some few minutes ago. And this one again depends if you use the full method. If it's partial method, we don't use it here. So impairment, you can only record it here if we use the full method in the goodwill computation. The same way I said that for you to get this goodwill of NCI, you must have used the full method. So that is okay. So that the balancing figure is the one you record there. So 20% of 16,500 that is. So this is 33. We have 20% of 8190, 1638. Then 20% of 1600, 320. So there was no depreciation overcharge because there was no sale of fixed asset. Then this is 20. So 20% of 800 is 160. 20% of 700 is 140. So the balancing figure, so that is 300 plus 1638 plus 320 plus 680. So this is 5938 minus 20 plus 160 plus 140. So this is 5618. So the balancing figure, that is what you record here. So retained earnings. So for the retained earnings, so we check the question. So we check the question. So the first thing we pick is all about those balances of the relevant question from our books. So those are the balances we pick from our books. So for Ambaza, from the statement of financial position, we have 34,560. And for Rudisha, the relevant retained earnings is 8190. These are from the statement of financial positions. Then the dividend receivable, which was never recorded, we add back here because they have to increase our retained earnings. Remember that here we recorded 20%. We added to the parent. So the 80% of that balance is the one to appear here. So 80%, if I say 80% of 1200, so that is 960. Then what do we debit? We debit things like UPS, so 80%, but the parent is taking 80% of the 100. Depreciation undercharge. So depreciation undercharge, you say 80%, it was 800. We have things like impairment, 80% of 700. Then after this we record about pre-acquisition. Pre-acquisition retained earnings of Rudisha. The time when Rudisha was acquired, its retained earnings was what? As per the start of the question there, you were told it is 12,500. As at the time Rudisha was acquired, this is the relevant retained earnings. Pre-acquisition. Pre-acquisition is the same as the retained earnings as acquisition date. And then after that, we talk about the NCI of this. Remember, the parent never controlled 100% of that one. He controlled up to 80%. So there's 20% going to the NCI. There's 20% going to the NCI. So if I take 34, let me get these percentages first. So 80% of 100. So this is 80. What about 800? 640. What about 700 of that? 80%, 560. What about 12,500? And so this is 10,000. And what about 20% of 8190? 1638. So let's get the balancing figure. So 34, 560 plus 8190 plus 960. This is 43, 710. So 43, 710 minus, so this is all about 80 plus 640 plus 560 plus 10,000 plus 1638. So I'm getting 3792. So that is a balancing figure there. So this is the balancing figure. So 3792. So let's now balance this question. We check if it's balancing. Because now I can see we have analyzed everything as required. So we add the assets, 62, 160 plus 2800 plus 28,700 plus 12,150 plus 4860 plus 1390. So this is 112,060. So after adding the assets, so I can see here there's a mistake we did under this. So this one is not supposed to be 22, because if I take 8200 plus 2800 minus 1400, so this one is supposed to be 96. So that if I add my equity and liabilities now, I think it will balance. Yeah, so it's balancing, so that is okay. So 112, 060. So you can see, this is the mistake we did here when we were adding. So you have to change this. You have to change that one from 22 to 9600. So this is how you were supposed to do this question. So you can see it's an easy question. You can be able to get a lot of information from it, and it was having 20 marks. So as you watch this video, remember that there's many students doing CPA in this country. Share to the groups. Share to the relevant groups you are, so that other students can be able to benefit from this platform. And I request that when you go to the center of doing exams next week, remember that there's some students who might be in need of financial reporting tutorials, maybe the one coming from the lower level, and the same student, who is moving to the advanced level. You are highly welcome to the online classes next semester. The financial reporting students, I know that you are moving to the advanced level. So welcome. We start the classes earlier. After the end of the election, prepare to join so that we do our preparations early enough. So my number is 0728 760 546 for the guys who would like to join next semester's classes in the advanced financial reporting. Reporting. Now this is the way we will be doing our classes. So remember that for the guys who have been attending these classes, there's that other platform we were using. Now I'm moving to a new platform whereby I will be doing now classes, on some cases live sessions, whereby it's a one-on-one but virtually interaction. So thank you for your time. I wish you all the best in your exams, and never forget to subscribe. So never just watch without subscribing. Subscribing is free. There's nothing you are charged. I thank you for your time.